Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host. Today's guest is Emmanuel Daniel, author, entrepreneur, and global thought leader in the future of finance. Emmanuel Daniel is listed as the top 10 global influencer in the Fintech Power50 list for 2021 and 2022. Much of Emmanuel's writing covers the future of finance, with a special focus on how cryptocurrency, blockchain, gaming, and other technologies are opening the doors to new transactional opportunities. Emmanuel travels widely and has visited more than 100 countries. In his first book, The Great Transition, The Personalization of Finance, outlines the transition that the finance industry will go through from its platform stage today into the personalization of finance, and was just published in September of 2022. He's working on his next book, tentatively titled The Winning Civilization. And as an entrepreneur, he was previously a member of the Entrepreneurs Organization, EO, a prestigious group of young business owners worldwide. Emmanuel was trained as a lawyer, has a degree from the National University of Singapore and the University of London, and attended courses on economics at Columbia University in New York. He travels widely and divides his time between Singapore, Beijing, and New York. Emmanuel, thank you so much for being here on the show today.
It's great to be on your show. I've seen some of your previous podcasts, amazing ground that you cover, and I hope that I'll be able to add to what you do.
You're very kind. I appreciate that. Tell us about your background and as an entrepreneur and how you go into the financial writing.
In essence, I qualified as a lawyer, decided on the day that I started work that this is not what I wanted to do, spent 10 years in the corporate wilderness, and then started something called the Asian Banker, which gave me the chance in 1996 to visit any country that I wanted to across Asia, meet chairmen and CEOs and leaders in the banking industry, understood a lot about how these countries were evolving. And in the 1990s, well into the 2000s, many of the Asian countries were growing economically dramatically. So having a front seat view of countries as diverse as Singapore and China, and then now India and the Middle East, I've been able to grow my business to Africa. Now, what's interesting is that as I grew the Asian Banker, I had visitors from the US. The foreword to my book is written by Barney Frank, who is the author of the Dodd-Frank Act, and he's a personal friend. And like Barney, I can throw a few names in there of leaders in the US corporate world who would go to Asia, visit, and to understand what's going on. And I had time with them that nobody in the US might have had, because they had all the time in the world, 2 weeks, 3 weeks. And from there, I got a sense of some of the developments in the US. So when you tell me the story of Wells Fargo, I understand it from the inside out, because I was able to see, understand a little bit of the personalities who drove some of those decisions that, turned up in the story of, Wells Fargo, JP Morgan, and a number of community banks as well. And more recently, I've been getting to know some of the Main Street banks in the US. So it's been a whole circle in that way. And sometimes it's great to have a view from the outside looking in. I do spend a lot of my time in the US now, and I'm trying to come to terms with what the US means to the rest of the world. And I think that, I'd like to contribute some of my perceptions in that field, in that area as well.
That leads me to my next question. What is specifically that drew you to finance as it relates to technology?
In the business that I created, my relationships had a lot to do with traditional banks. And the people who sponsored a lot of our activities had to do with the technology companies that needed access to these traditional banks. And at first, for a long time, the formula in the evolution of the finance industry had to do a lot with the supply side of the industry, how these institutions dictated the agenda by which they provided services to their customers. So when I had on the cover of my book, I say the personalization of finance is here. I spend a lot of time right now trying to explain to traditional banks that this is not about you being able to personalize finance to the customer. So banks like to think that because they have more on the customer, that they have better distribution channels like digital banking and so on, that they're getting the formula right. The essence of my book is that the rules have changed. The rules are changing dramatically. The customer has greater control over who he wants to relate to and who he wants to give his data to. Through the token economy and so on, he's able to create entire ecosystems by which value is transferred between people, where the financial institution may well not be included in that transaction. So a lot of my conversations have to do with trying to explain to traditional players personalization of finance, has more to do with the user of finance rather than the provider of finance.
The data is rich. Whoever owns the data is going to be able to make some intelligent decisions. Now the banks, we'll get into that in a little later. I'm excited to hear your thoughts about private equity and the future of investments in the innovative financial technology.
Cliff, I've had a front seat view. Many of the private equity sponsored transformation of financial institutions in the last 20 years or so. In countries as diverse as Japan, Southeast Asia, Thailand, Indonesia, and Indonesia, especially after the 1997 Asian financial crisis, the private equity players came in, looked at the traditional banks and said, if these banks were able to do the right thing, they'll be able to, X their value up many folds. And there are many stories around the world of private equity driven transformation of financial institutions. And in that period, a lot had to do with just doing the basic things right, cleaning up the balance sheet, getting the non-performing loans off, and then focusing on the customer, putting in place the right CEO and so on. Now, that realm has changed somewhat. Today, when my private equity friends look at what their venture capital friends are doing in fintech, for example, financial technology, is a totally different ballgame. What the fintech players are saying is that give us time, burn money with us, and we will scale the ability to distribute financial services a lot better. Now, and where the fintech community gets these ideas from is from the technology world's focus on the platform era, where financial institutions are trying to mimic, the social media platforms, the supply chain platforms have been able to do. But financial services is somewhat different in that just because you're able to onboard millions of new customers on a digital banking platform does not mean that you're going to be able to profit from, that ability to use technology to onboard, and I call it the industrialization of finance. In other words, doing what banks have traditionally been able to do, but industrializing it because of digital access. So if a traditional bank gets maybe 10,000 new customers at their branch network, a digital bank might be able to get 100,000 new customers on the platforms. But the thing that the platform industry does to finance is that it commoditizes it. And what you find happening at the end of the day is that the real driver of any transformations that the fintech players talk about still comes back to price war, commoditization. In other words, they have to incentivize their customers by giving them better rates. And it was never about the technology itself. Now, a private equity player looking at this realm and how it functions cannot justify going in there to scale up a digital bank or a buy now, pay later player and so on. because they are based on a totally untenable proposition from a private equity point of view. I was just thinking that with the slowdown currently, whether there are, like digital banks or banks with a strong digital proposition that can be taken over by a private equity player and then scaled up. The rules have changed. In the old days, there was real income being generated in the traditional banks. Today, there is no income. There is just a transitioning of the power game, of the ability to onboard customers and so on. So what I've done in my book, by the way, I did not write my book for the private equity players, but in the middle of my book, I go back into what I think are the essence of finance or the essence of the financial industry that gets transposed into the digital age. So, for example, one of the things I say is that finance is still a balance sheet driven industry. What is a balance sheet driven industry? Just think about this. The most profitable banks in the old days were not the banks with a strong lending book. It was actually the banks that had a strong liabilities base, a deposit base. And that's one of the magic of finance. Because in any other industry, it's the performing assets that generates profit. But in finance, if you're able to keep the cost of funding low, there are many things that a bank can do with its balance sheet. And that's something that private equity players appreciate more than venture capitalists. Then when you apply that into the digital era, you discount the ability to onboard customers very quickly if it doesn't result in lower cost of funding for the institution. So and like that, there are a number of other truisms, I think, that we can carry from traditional banking into the digital era, and by which we assess some of these new players coming on board.
Let's move the conversation a little bit to personalization of finance and how we're moving towards the financialization of everything. How will it affect the financial institutions, the markets? We're seeing crypto, the blockchain, and the metaverse play a role now.
When I use that phrase, the personalization of finance is here.
Yes.
One of the challenges I find that I have is to explain to the traditional bankers that the personalization of finance is not a supply side personalization. It's not the ability of the traditional institution to ace the game, to be able to make the customer feel like he loves his financial institution, that the services are rendered seamlessly and so on. It's not a supply side driven idea. The personalization of finance is taking place on a number of different elements. You take the token economy, for example. Because of tokens, there are, during the pandemic, I've been able to observe that there have been communities in different parts of the world with the lockdowns being able to use play-to-earn gaming platforms to generate real income, with which they exchange for real money and then go out to the village and buy food to eat. There's a development of community currencies in pockets in Africa. There's one that I know in Kenya called Safaru Credit. And Kenya has a functioning fiat economy. But in small villages, which does not have a money-driven economy, the question arises as to how to generate value and capture it, and then to transact that between people in that economy. So community currencies are also going digital now. So when I say personalization, I'm actually referring to the trend where the individual has greater control over his transactions and the way in which he captures value. Now, the personalization of finance is also predicated on the transformation taking place in the technology industry. Mm-hmm. Technology is transitioning from its platform era to personalization. This is the year that Facebook has started seeing number of users start go into decline. And it's actually losing market share to new channels. You can say that TikTok is one of them, but TikTok itself will go into decline because it's a two-dimensional visual experience. And when we see new technologies such as virtual reality come into being, new players will then pick up the slack and then dominate for a while. So this transitioning is a moving target. It started with the business model moving from the platform industry through I don't want to use cliche phrases and throw in blockchain and everything else, but But these are the technologies that are making it possible for the individual to gain greater control over how he captures value and transacts value.
It's interesting because we're going to see the consumer is going to have more power.
The user is going to have power, and he's going to exercise the power with other users.
Excellent.
So the way in which a financial services player or a financial services provider plugs into that power will have to change. So for example, today, you and I exist to a bank because we have something called a bank account. That's actually a static representation of our balance sheet with the bank. It's a historical representation of how much money we have in the bank yesterday. When tokens are managed by individuals by themselves, the bank or the financial institution will have other problems, such as the problem of trying to identify, who you are, because you are not what I think you are, because you exist in my balance sheet, in my general ledger. The general ledger of the bank's, balance sheet. You are who you are because I need to go out and capture an idea of who you are and your identity, being able to verify it and to create a credit profile around you. I seem to be speaking in abstractions here, but just imagine a world where on my mobile device, I'm able to send out a message to anybody sitting around me in a restaurant and saying, I would like to borrow $10 to pay for my meal. And the people who want to, relate to you will need to know, firstly, who you are, that you are genuine, that whatever transactions that they do with you is immutable, and that they have a profile of your credit history. Now, all of these data today, it's possible. It actually exists various forms in tokens, in public profiles, and so on. It's just bringing them together that makes it work. Banks need to understand that the data that sits outside the institution is becoming more important than the data that sits in the institution. And that's the transition that financial institutions will need to make. Now, as they make that transition, the assets that they carry themselves and the service that they provide will change. A bank's most valuable service might well be providing a credit profile so that individuals can transact with each other. Now, we are in a transition. And what this means is that when we look at some of the players who have challenged traditional banking, we call them disruptors. Now, they have gone halfway. So when you take a peer-to-peer player, P2P player, or a buy now, pay later player, you will see that they started by saying, hey, you don't need to get a loan from a bank. You can get a loan from anyone out there. Now, we will aggregate information on the borrowers and the lenders, and we'll bring you guys together. Now, that industry, the peer-to-peer industry, threatened to disintermediate banks. But what it ended up doing was that it started to look like the banks it was trying to replace, because the product that the peer-to-peer players were trying to put out there was a traditional loan, was a mortgage, just like what banks do. And over time, as regulation began to creep in, they were slapped with all the same costs as a traditional bank does. Now, and then the same thing about buy now, pay later. That business of being able to swipe a credit card and the option, pops up to tell you that you can pay in installments and stuff like that. That has existed for the last 20 years. So the back end, nothing has changed. What these new industries represent is so much data that is now available to all the parties in a transaction, that a new set of ideas on what products in finance should look like will emerge. So a product in finance does not need to be a mortgage. It can be a time-based mortgage where you pay certain amounts at different points in your life, depending on how old you are and how long you want to pay. It can be a lease, because you might find 10 other people who wanted to own the same property and come up with agreements and so on. Now, it's that data and the network effect of that data that will transform finance as we know it. Next year, in the US, the Fed is about to introduce something called FedNow, which is instant payment between individuals. Now, the amazing thing about FedNow is that it levels the playing field between large banks and small banks, so that if you have a bank account with a small community bank, you can do instant payment to your pal wherever in the country, regardless of the size of the institution. So then what happens is banks will start needing to take one step further and say, okay, we have all this data of who's transacting with who. What do we do with it? How do we add meaning to it? Now, a lot of what I'm saying already exists in other countries. And, you started the introduction by saying that I spend my time between Singapore, Beijing, and New York. And in China, this whole idea of a community-based application already exists, and it brings together rich people and poor people. It brings together suppliers and users of finance on ecosystems. It doesn't exist in the US because the traditional banking industry is very strong, and the traditional infrastructure for payments, which is very credit card based, has been there for a long time. But as the Fed moves in to provide greater ownership to the end user, the financial institution will find that it will start running after the user and trying to demonstrate more value than it has so far.
I'm working with a company, and we're on the metaverse, and with NFTs, and you can buy the NFT, where you could buy the physical product right along with the NFT. No one says you got to take delivery of the physical product. And then at a later day, you want to sell the NFT, then it's up to the individual that acquired the NFT to make a decision if they want to get that dress, that pair of sneakers, whatever it may be, that may be in storage at a 3PL. The idea of trying to reduce the amount of returns and the personalization, we'll figure out there's a large data set there, and who owns the data is one of the key pieces that you were nice enough and you really shared. But the idea, we may be able to ask the individual consumer or business to opt in and be able, we know the data is getting sold now, but the consumer is doing, they click a box and all of a sudden it gave permission for the acquirer of the data to be able to sell it. But I think they should be able to turn around and say, no, that's not acceptable. I think you need to pay me for my data. So there's some sort of a revenue share back to the consumer or to that business where the data is being acquired. There might be micro payments per transaction, but now at least we're sharing in that ecosystem that the acquirer of the data, is actually profiting from. And now we have a little bit more respectful, let's change topic a little bit. We look at staking in the cryptocurrency. They're paying individuals to create the fluidity within that market at this point. We got to be a little careful with the whales that'll come in and, upset that market, and there's smart people who are working through that, how that will take place to prevent somebody coming in and dumping, in essence, selling a lot of currency very quickly. So it's an exciting period of time. I guess changing the topic a little bit, I'm very interested because you got this global view, and you've got one book that just came out in September. You've got another book that you're going to be publishing shortly. Our listeners hear about the global financial order. Please share your views on how the dysfunctional economies are shaping the future of global trade and commerce.
As I was studying how decisions were made in finance in the last 100 years or so,
right,
and then trying to project, which country will, shape the future of finance, I came to the conclusion that it's the dysfunctional country, not the organized country, that will shape the future of finance. And why is that so? The most dysfunctional country when it comes to finance, and didn't care about being dysfunctional, is the United States.
Okay.
The US has been in debt from the time it raised, bonds to fund the War of Independence, the Civil War, and all of that. And it's come to a point today, the total debt of the country is now $29 trillion. The GDP is $19 to $20 trillion. And the ability to meet its commitment is a moot point. It's the ability to issue more debt that is now the real economy. It just happens to work in the US favor that the rest of the world believes in the US. And therefore, many countries buy US sovereign debt as part of their own. That is a formula that has, that stayed on and it's not looking like it's going to change anytime soon. So we keep our eyes on elements like that to see, how finance will evolve. Why did the US dollar become the global currency? Because the US didn't care. There was no policy by the Fed or the Treasury saying that, we need to make the dollar a global currency. I mean, the Treasury was funding a lot of the Marshall Plan countries. At the end of that, they actually restricted the dollar from coming back into the US, right? So, and there was so much dollar floating around outside the US that it created an economy by itself. Investment bankers in Italy, in Spain, were issuing bond in the dollar because it was cheaper than issuing bonds in Russian rubles or any of the European currencies. And then that took a life of its own, and the oil money came much later. Now, so because the US engagement with the rest of the world is on a commitment to meet its obligation, that's the core of the engagement. As long as that doesn't change, the US has the ability to export, its reserves and for the dollar to continue being a dominant currency. Now, the question then is, should the US digitize its currency so that it can take its life of its own? And if that's the case, then should it digitize it by issuing a central bank digital currency like China has, or should it take a laissez-faire approach and allow any number of regulated stable coins to be the representation of the US dollar around the world? Now, all of that is dependent on how decisions are made, in Congress, how the relationship between the different agencies in the US works. And history tells us that very often events, supersede the ability to make decisions in the US. And eventually, when it does make its decisions, it's on the basis of a necessity that has become, real at that point in time. At the same time, when we think about the efficacy of cryptocurrencies, for example, it's the countries that are dysfunctional around the world where the local people rather trust a crypto than their own currency, and things like that. So you look for dysfunctionalities and then see how, out of desperation, any economy, embraces a new technology and then just latches onto it and let it carry into the future. That's the way I see how finance evolves. The countries that think that they can ace the game by dictating how the evolution takes place. If you take China, for example, it's issued a digital currency of its own, but it wants its cake and to eat it. In other words, it doesn't want to allow its currency to be traded openly in the global marketplace, and therefore there's not enough liquidity of the renminbi outside of China. At the same time, it has a serious problem where the renminbi is actually more expensive in China than it is outside China, right? So, and the reason is that they needed to keep it artificially inflated in order to hold the whole banking system together. Now, it's only when China deals with these issues and sees parity between what it has to achieve domestically against being affected by global trends, then I will say, the Chinese renminbi stands a chance. So I'm not saying it'll go one way or another. I'm just saying that these are the elements that I look at to understand and make my own conclusions as to how the global economy will evolve and who will dominate the financial economy.
This is a very high-end conversation for our listeners. We're really getting into the forensics of reserve currencies, and as it plays out, debt and crises come into play. The rules will evolve and change, and additional power will be attained by certain legal entities or governmental agencies at this point to deal with some of that. The goal is really to prepare our listeners, not to alarm them. What do you see as the subsequent financial difficulties we will face?
When you look at the balance sheet of any bank and understand what it was in substance in 1984 and what it is in substance today, and the balance sheet of any large corporation, whether Apple or GE, which are highly financialized, meaning that they make more money from their trading account than they do with their core business. And that's what I mean by financialization for corporations. The balance sheet of a traditional bank in 1984 had real mortgages on them. And why 1984? Because that was the year of the period of the first financial crisis in the US, the savings and loan crisis, and they were not able to match their assets and liabilities at that time. But the asset itself were actual mortgages, mom and pop mortgages from the neighborhood in the community that they serve. Today, the average balance sheet of a bank is made up of ephemeral assets. They got a bigger trading book than they have mortgage And guess what? They take on the mortgages and then they hive off and they sell them off. So again, they generate income where the mortgages no longer sits on the balance sheet. So you're actually looking at a fundamentally different balance sheet today than you saw in 1984. So as institutions and their balance sheet becomes increasingly ephemeral, and a lot of the assets, derivatives of derivatives, the factors that affect the economy and perception of the valuation of the assets also become increasingly ephemeral. So what I say in my book is that in 1984, it was the real value of mortgages that affected perception on a business. Today, it can be anything. It can be a perception on a whim of an event that took place just yesterday, and the perception that a financial institution will not be able to pay its commitments. So we're actually transitioning into financial realm that is going to be driven more by perception than reality, than any underlying assets going forward. Managing the information era, managing perception of your ability to meet your commitments is far more important than anything that you have on your balance sheet.
It's interesting. You got the social side of it, meaning the media, and how quickly something can actually go viral in the community at this point. The other side of it is we've got a huge amount of derivatives that are in place. You were nice enough and you brought that up, Emmanuel. And the counterparty type liability that's sitting there. What happens if the counterparty is not able to make good on that liability that's sitting there? You know, the snowball effect and the size of the derivative industry. It's interesting at this point, you know. Let's pull back a little bit. Let's help our listeners. What would be the corrective action to avoid? In other words, if the politicians and central banks don't heed the warning signs that we're starting to see a little bit here, how can our listeners position themselves to protect their assets and actually profit?
You know, because a lot of corporate profit in the US today comes from financialized assets. Impossible. It's now a moot point to turn the clock back. We now exist in a financialized economy. The ability to manage, ephemeral assets is central. It's a survival tool now. The underlying business, it's even secondary. If you look at Apple, for example, it's got more cash than, all but the top 4 countries in the world, So what is Apple? Is Apple a manufacturer of, devices, or is it a trading house? So I think that we need to come to terms with the fact that the largest and the most dominant of our businesses are more trading houses than they are businesses with an underlying business proposition. And the thing is that I think right now there is a dichotomy between the way Federal Reserve Bank perceives its own objectives. Central banks around the world, the Federal Reserve Bank is not unique in this, writes its own KPIs, its own mandate is very, very narrow. Managing inflation and ensuring employment. Just this, it uses the assets that it has at its disposal in a very narrow way, without a total description of how that goes on to have a knock-on effect on financialized corporations, the markets, and so on. And I think that we need to see that gap, being closed down as far as possible in order to find stability in the local economy going forward. Except that central banks have been on a journey of, ensuring their independence and keeping to their mandate, very narrow mandate, for the last 50 years. I think that has to shift now, and we need to give central bankers far greater responsibility over, how the impact of what they do with, the highly financialized corporations. Not just in the US. I think that many more developed countries have the same problem, even Japan and China today.
See, that's extremely insightful. This is a very high-end conversation because we're really looking at something forensically at a detail level, but the long-term effects of decisions that are being made, and here we are, end of October, let's assume this will go in November. We're probably, in the US, maybe even on a global level, energy prices are increasing quite substantially. The recession, we probably in 2023, some of the major bankers at this point are suggesting we're heading in that direction. They're trying to put in tame inflation. We knew, bright individuals like yourself and I and others in the industry knew that if interest rates stayed very, very low for such an extended period of time, it was going to create the situation we're in at this point. The corrective action was going to be very painful. If you look at the AI machine learning, we repeat history over and over again. The question is, are our financial, the treasury, the folks that are running these institutions going to learn that it's cause and effect? In other words, the idea of playing war games, in essence, in the financials. If we do this, this is what it looks like 3 years out, 5 years out. Do we really want that? Should we bite the bullet earlier, take the pain, so we don't actually have something that could be much more painful or catastrophic? So, these are the high-end conversations. And I guess the politicians have wiggled, well, they're involved in the day-to-day on the financial side, and they're trying to do things that make them so they get reelected, because we have an election coming up in November, early November here in the US. So we could see the stress there being put onto them. And many of these fine folks are actually appointed by our elected officials and confirmed by our elected officials. So that's not really laissez-faire on those individuals running the treasuries.
The good thing about the US is, today we have the Federal Commission to bring all of the different regulators together. So at least they're talking with each other now. What needs to happen going into the future is for us to hear, the treasurer and the Federal Reserve Bank presidents talking the same language, saying to themselves that we are out to solve the same problem. Right now, they seem to be keeping to their turf, as it were. It's only when there is a unified approach, a kind of a holistic approach, that you see that, things get done. One of the biggest problem in the US is to ensure that wages keeps up with inflation. And this is an agenda that hasn't changed since 1995, when Jack Welch, told the unions that, if you can't keep your wages down, I'm going to India or to China to go and do my manufacturing. And it's the large corporations that have held the agenda, but none of them are being taken to account by any of the the regulators,
not in the
Treasury or the Fed. So it has to be a unified approach, and only then we will start seeing results that will show up on the street, that people can afford their livelihoods, and that they can, tend to inflation. Keeping rates down wasn't necessarily a bad thing. It could be applied. Every phase in economic history gives an opportunity for new revolutions to take place, and so on. So a lot of the technology revolutions that we're seeing today was actually a result of, low rates. You had investors taking risks that they wouldn't otherwise take. So right now, there's probably a hiatus, while investors take stock, which is also a good thing, because then we take a look at technologies that work and those that don't. So I think that greater cohesion in regulation, in policy making, I think that's part of the thing that we need to see in order to see the impact on the street.
I can appreciate your views on that. Is there anything I haven't touched on that you would like to add?
No, the most important thing I had in my mind was what we talked about in the beginning, which is how private equity people should look at venture capital and fintech. So that was the big thing in my head.
Very important. There's a lot of dry powder right now. It's a little confused. They're advising some of their portfolio companies to, sort of batten down the hatches, reduce spend, aggressively go out for collections.
I'm a big fan of the PE people. The PE people I know are very sensible. They are super disciplined on their balance sheet, so they know what they're dealing with. I mean, that's a known factor in the way I think about how things come together. The venture capital people, it's wild west. It's like, throw that money out there and see what comes in. And now with rates going up, they start to discipline as well. So I'm a big fan of the PE industry.
A lot of the PE team members, a lot of our listeners, the majority of our fine folks that we're interviewing are managing anywhere from $30 million to $3 billion as a rule of thumb. It's that range, assets under management. They co-invest with the investors. So it's their money aligned with the investors. So these decisions that you're making, the housekeeping and the financial, really understanding the decisions they're making based on, what their metrics they promise the investors is really about themselves. They're aligned with their investors. So I think that's extremely important.
One point that I think I would like to share is the difference in the way that valuation is achieved in the US and countries in the world. I think that in the US, because you've got a very open and active capital markets, a private equity player can just go to the market and let the market decide for him. But because in many of the other countries in the world, whether it's Japan or Singapore, and almost every other country except maybe the US and the UK, valuation is achieved through the role of whales, important and who are able to take a position, and then everybody else benefits from that. When you look at what happened in China, when Alibaba was first identified by Goldman Sachs, there was no valuation in China. And then it was only when Alibaba went to the US stock market that the idea of valuation started to be anchored in China, despite having a dysfunctional capital market. The Chinese capital market is essentially state controlled, 70% of its equities owned by the state. So the price discovery mechanism is opaque. A private equity player from any other market or from the US going to China will find it difficult to find what an active valuation should look like. Alibaba provided that. And then when you go into Hangzhou, Alibaba provides the whale effect for its own local community. And so it created a few billion-dollar companies because it was the primary investor as a result. And then you go to different provinces in China, you will find that there will be an Alibaba equivalent. In Shenzhen, it will be, will be Huawei or something like that, and then in Shanghai and so on. I'm very interested to see how the role of anchor institutions or anchor investors will look like. In Southeast Asia today, Singapore, for example, has been attracting a lot of ultra-high net worths to be based in Singapore. So it's become a wealth management center, a private banking center, and the number of family offices has increased dramatically. And these players are the ones that provide valuation for the Southeast Asian market in general. So this is something that I see, you said travel a lot. So these variations that I see on the theme of valuation around the world.
Well, you're seeing an ecosystem. It's something's driving it, and it's the ultra high net worth.
In Southeast Asia, ultra high net worth, because the ecosystem is highly fragmented. In the same area, you have 12 countries or more. So each one, much smaller than if they were one, and so on. So there, in such an economy, individuals can play a stronger role than in the US, where, it's the large corporations that dominate.
Excellent. Emmanuel, how can our listeners contact you? Are there any links you would like to share?
Everything you need to know, my book.
Show us your book.
The Great Transition, the Transition of Finance is here. You can get that from my website, which is emmanueldaniel.com. That's easy. And from there, any information that you want, and also to be able to contact me from there. I'll be happy to exchange ideas and test ideas with, any of you.
I'm going to address an important topic, as 95% of our founders don't know how to sell their companies. I've co-founded with the global team at the Hyper Accelerator, a new market-leading mergers and acquisition accelerator program to help founders prepare to sell or merge their company within our 100-day global virtual accelerator program. The M&A Hyper Accelerator will prepare portfolio companies to be acquired and maximize their exit value, integration, and life post-sale. You can learn more about the program at startupcourse.com and click on the M&A application. Again, that's visit startupcourse.com and click on the M&A application. Thank you so much for your time, Emmanuel. Your knowledge on the future of finance and how technology will change everything will certainly benefit anyone who's listening today. Thank you for sharing your expertise with us. I want to thank our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination, LLC.